What's going on, guys? It's Stas here. Welcome back to another video. So today we're going to be doing a little bit of a different video. We're not on my computer looking at technical analysis, looking at charts, but we're going to be doing a whiteboard video just to throw in some different types of videos on this channel. I kind of want to start diversifying the content that I'm producing for you all. So as you read in the title of this video, I'm going to be going over 3 ways to help yourself prepare for a stock market crash. So bear with me, guys. I don't have the proper lighting. I'm currently shooting on my iPhone 8 Plus, so the quality's probably not 100%, but I am getting a camera soon so I can bring more quality videos to you guys like this one, as well as some new lighting because I know it's kind of dark right here. And just bear with me, guys. This is my first kind of video like this where I'm doing whiteboard content, so I hope you guys enjoy. And for those of you new viewers out there, my name is Stas and I make videos dealing with swing trading, day trading, long-term investing, and my personal philosophies and strategies when it comes down to investing and trading in the stock market. So if that's something that you're interested in, feel free to drop a like, leave a comment, and subscribe, and let's get started with the topic of this video. So you guys read in the title, how to prepare for a stock market loss. So the first rule that I personally go by, and I usually tell other beginners out there, is to have 30 to 40% of your portfolio in cash. So you want 30% to 40% of your portfolio in cash. So let's say, for example, you have a $10,000 portfolio. You would want $3,000 to $4,000 set aside for you to be able to invest in stocks and pick up very cheap deals in terms of stocks as the market is going down. So it's a myth out there that you're able to time the market, but during a crash, you're able to buy stocks at very, very cheap prices, and they're going to appreciate over time once the market gets out of that crash. And just for some clarification, guys, a 10% downwards move is a correction, a 20% downwards move is a bear market, and anything above 30 to 35%, up to 50 to 60% is considered a crash. A 60% downward move in the stock market is considered a crash. So just to put this into perspective, think about it, guys. As the stock market is going down in price, right? The assets are going down in price. The prices are going down in price. You're able to invest on the way down, right? You're picking up the bones. You're picking up very cheap deals and very big, large name corporations like Apple, Facebook. You're going to be able to pick up very cheap deals in Disney, all these big, big companies. And, as the stock market starts to bottom off and push back up in price, all of these shares are slowly going to start appreciating in value, and all those very cheap deals that you got here, they're going to be worth way, way more once we start hitting that bull market. And if you've guys done your research, and if you look back the past 50, 60, 70, 80 years in the stock market, every time that we see a correction, or a crash rather, every time we see a crash in the market recovers and pushes back to another higher high. And every time, guys, this happens, and the number one rule that I personally live by is buy stocks while others are fearful. Obviously, when the market's going down, people are going to be selling off, and not many people are going to be buying the stocks. But if you want to get rich over time, guys, you have to be buying stocks as the stock market is crashing, because that's the number one way you're going to accumulate wealth over time. So again, guys, 30 to 40% of your portfolio should be in cash, and this is the number one rule. And the first way that you can help yourself during a stock market crash and help yourself prepare before the stock market crash happens, because we do see the last crash that we've experienced was in 2008, and now it's obviously 2018. Not saying that there's a stock market crash right around the corner, but it's always safe to be prepared and have some cash set aside, so when it does happen, because it will happen, you're going to be prepared and you'll be able to invest on the way down and then appreciate those assets as the stock market starts to push back up in price. So that's the first thing to do to help yourself before a stock market crash. So the second way that you can help yourself before a stock market crash, to help yourself prepare for a stock market crash, is to put some money into gold. And I'm going to have some statistic laying over the screen right now, and we can clearly see that during the biggest S&P 500 declines over the past 50 years, we see that, okay, in September 21st, 1976, the S&P 500 declined 20%. And during this time period, gold went up 53.8%. So gold absolutely destroyed the stock market, right? It beat it by over 70%. And we see the next crash in 1980, the S&P 500 went down 27%, and this is actually the only time where gold dropped even further below than the S&P 500 with a 46% downward move. But then we see all the other years after 1982, gold in 1987 went up 6.2%. As the S&P 500 dropped 33.5%, and the next crash we saw in 1990, S&P 500 went down 20%, and gold went up 6.8%. And then the next correction that we saw in July 1998, gold went down only 5% as S&P 500 went down 19%. Now we see the two biggest crashes were in 2000 and 2008. These are the most recent crashes in the stock market. And we noticed the S&P 500 went down 49% in 2002, 2000 to 2002. And during this time period, gold went up 12.4%. So if you put your money in gold in 2000 to 2002, you would have made 12.2% on that investment. But if you had your money in stocks in the S&P 500, 49% would have been your loss. So you see the extreme difference in percentage value growth and loss in terms of S&P 500 stocks and gold. And we noticed in 2007, the same thing as the previous crash, 57% loss in the S&P 500. And this is obviously the biggest loss that we see here on this particular chart. And during this time period, gold went up 25%. So if you were able to put your money, $10,000 in gold, you would have made $2,550 on this particular investment. Then the next little mini correction that we saw, 20%. In May 2011, gold went up 9.4% in this particular time period. So gold, guys, it's a very good place to put your money, and it's very stable over the time periods that we just saw in that chart. We do understand that gold is a stable place to put your money during a stock market crash. And just to draw a little visual for you guys, you know, as the markets are going down 60%, right, like we saw back in 2008, minus 60%, gold, your money in gold is going to be going something like this, right? It's going to be growing at a very slow pace, but it's a very good way to hedge against a huge stock market loss, because obviously you don't want your money in the S&P 500 in these stocks during this correction period, during this big crash period, but rather you're going to want more of your money in gold, you know, as gold has shown over the past that it doesn't crash during a stock market crash. Rather, it's either at 5 to 10% growth or as upwards of 25% growth. So that is the rule number 2. Put your money into gold. Put some money into gold to hedge against your positions that you do have that you don't want to sell during a crash. And you know, this is a great way to save some of your money during a stock market crash, and a great way to help yourself to prevent any big losses during a stock market crash. And the third and final thing that I would recommend people to do to help prepare for a stock market crash is to have a very heavily diversified portfolio. So diversify, I can't even spell, diversify your portfolio. So a bunch of beginners, just to get deeper into this, a bunch of beginners that are hopping into the stock market are buying big brand name tech stocks. These are the hot stocks in the stock market, like Netflix, Apple, Facebook, Amazon. These are the biggest stocks in the stock market, right? And what I mean by diversify your portfolio, have an arrangement of assets from small cap investments, mid cap investments, and some large cap investments like these ones right here. And let's say you were all in on these particular investments right here, big cap, large cap companies. You know, once the stock market crash begins to happen, right? These are going to get hit the hardest. And we saw Apple just hit $1 trillion market cap. $1 trillion market cap. So what do you expect when the crash comes? You know, Apple is going to get killed, right? Apple's going to get hit hard. Facebook's going to get hit hard. And Amazon is going to get hit very hard, as well as Netflix. So what I'm trying to say here, guys, is make sure you have an abundance of different assets in different sectors and different, you know, different businesses in different markets to make sure that you don't lose a ton of money. Because like I said, if you have $10,000 and you're heavily invested in the tech sector, you're going to lose a lot of money during a stock market crash. And there's obviously different ways to hedge against this with options, you know, investing in gold, but that's a little bit more advanced. And I really want to just get into this basic diversification. And this is just a main thing that you all should be doing in terms of investing in the stock market and preparing for a crash. And this is something that you shouldn't be doing only to prepare for a crash, but in general, guys, you want to have some different dividend-paying investments. You want to have safer investments like J&J, Disney, these companies that have been around for hundreds of years. You want to have some speculative stocks, like maybe Tesla, like maybe, you know, all these different companies that have crazy future valuations that can 10x, 20x your money. You want to have stocks that are stable but still growing nicely, like Apple, like Facebook, like Amazon, even though I do think Amazon and Netflix are overvalued. But you just want to have a mixed allocation of assets, so when the stock market crash does come, some of them won't be hit as hard as others. Just think about it, guys. If you're heavily invested in a sector, let's say the tech sector, and that sector gets hit hard, your whole portfolio is going to get crushed. But if you have other diversified investments like J&J, Disney, big, large companies, McDonald's, they might not get hit as hard, as these certain tech stocks. And McDonald's is a very perfect example. If you guys look on the charts for McDonald's, they weren't hit hard at all during the 07-08 recession. I believe their stock might have actually gone up. And don't quote me on that, but just realize that McDonald's did not get hit hard during the crash, but other stocks got crushed during the crash. So pretty much, guys, just diversify your portfolio. Have a mixed set of assets in different sectors, different industries, different markets, and that should be able to help you guys during a stock market crash and helping you guys prepare for a stock market crash. So I hope you guys enjoyed this video. If you did, feel free to drop a like, leave a comment, and subscribe. Follow me on Instagram, Facebook, and Twitter. The links are all down below in my description. I post daily there, updates to my channel, profits, stocks I'm watching, and stuff like that. And I hope you guys enjoyed the video, found some value in it. Let's make some money today, guys. Peace.